They didn't hide the person. They hid the authority. On December 15, 2025, the SEC charged 3 former executives for accounting and disclosure fraud, alleging that a co-founder barred by federal court from executive roles continued to play an important executive and managerial role while disclosures described him differently. If you sign certifications about who controls your organization, this enforcement action just made checking the org chart an insufficient defense. The SEC alleges these executives falsified records and lied to auditors in connection with how the company described who exercised executive and managerial roles. The requested relief includes permanent injunctions, civil penalties, officer and director bars, and disgorgement, career-ending consequences for certification fraud. The question every board member and CFO now faces: what exactly did you verify about who actually makes the decisions, not just who's listed on paper? Start with what's documented. In 2020, a federal court issued an order prohibiting a company co-founder from serving as an executive or officer at any public company. The company continued operating. The co-founder's executive role did not appear in public SEC filings. Legal summaries describe him as being treated as a consultant rather than as an executive. Most boards would view this as compliant. Formal title removed. Court restrictions satisfied on paper. Disclosure language reviewed. Box checked. But the SEC alleges that while the co-founder's name disappeared from formal filings, his operational control did not. According to the complaint, executives misrepresented who actually exercised executive authority. If you certified executive structure while someone barred from those roles functionally ran the company, the SEC's position is clear: you certified something false. The SEC alleges executives caused SEC filings and public communications to misrepresent the co-founder's status and responsibilities. This wasn't accidental omission. The complaint alleges active creation of false governance representations. In governance terms, a consultant provides advice and lacks decision-making authority. But if the allegations are accurate, this consultant exercised executive-level control without the title. Public companies file regular reports describing executive officers and governance. Certain executives sign certifications attesting to accuracy. Those signatures create personal legal exposure. The SEC alleges the company's books and records inaccurately reflected who exercised executive authority. When internal records misstate authority, every downstream control relies on false information. The complaint alleges executives lied to auditors during the financial reporting process, active deception, not passive silence. The fatal assumption: if legal counsel approves disclosure language and titles are technically accurate, certification obligations are satisfied. This is the corporate fraud trap: certifying form while knowing substance diverges. In a prior episode, executives were charged for failing to stop known accounting fraud. That was gatekeeper liability for inaction. This case is different. The SEC alleges executives created governance deception themselves. Internal audit relies on management representations. External auditors rely on management certifications. Audit committees rely on disclosures presented to them. Standard compliance checks titles, charts, and wording. It does not independently verify who actually exercises authority. Auditors ask direct questions about governance and control. If management allegedly provides false answers, audit conclusions rest on incomplete information. Here's why this matters for external audits. When auditors issue an opinion on financial statements, they may also be expressing a conclusion about internal controls over financial reporting for certain public companies. That assessment depends on understanding who has authority over financial reporting. If the person who actually controls financial decisions isn't disclosed, the auditor's control assessment can be based on incomplete information. not necessarily because auditors failed to ask the right questions, but because management allegedly provided false answers about who ran the company. The complaint also alleges violations of internal controls provisions. If governance structure itself is falsified, controls cannot self-correct. Titles were verified, authority allegedly wasn't. That gap is now enforcement exposure. Securities laws prohibit disclosures that are technically accurate but materially misleading through omission. Calling someone a consultant doesn't make disclosures accurate if they function as an executive. Function controls over-label. When executives certify filings, accuracy is tied to substance, not nomenclature. The SEC is seeking injunctions, penalties, bars, and disgorgement, personal, not corporate, consequences. This action fits a documented SEC pattern emphasizing individual accountability when management misleads auditors. Certifying known divergence between form and substance converts governance deception into personal liability. That is the second corporate fraud exposure in this case. Boards verify formal compliance. They rarely verify operational reality independently. The verification challenge audit committees face is structural. Many committees have limited investigative resources and rely on internal audit, which reports to management. They rely on external audit, which relies on management representations. They rely on legal counsel, who reviews what management provides. The governance oversight structure largely assumes management provides truthful baseline information. When that assumption breaks, when management allegedly lies about who runs the company, the verification model can fail. False records, false certifications, false auditor representations, false SEC filings, regulatory action against individual signers. CFOs, audit committee chairs, and directors now have a concrete enforcement example, showing reliance on paperwork may be insufficient. Reliance on management representations may not shield liability, where there were reasons to question and no independent verification. The company is not named. The mechanism is the story, the belief that failed. Paper compliance equals certification and safety. The enforcement reality, substance controls liability. The SEC filed these charges on December 15, 2025. The matter is pending. Allegations remain unproven. If the SEC prevails, the relief sought is permanent, personal, and professionally devastating. Certification liability, according to this enforcement theory, follows substance, not form. Every executive who signs governance certifications now has a reference case. Not, does our paperwork comply, but, does our operational reality match what we certified? I analyze corporate fraud patterns, so you don't have to. Follow Scam Beast if you're accountable for money, risk, or approvals. Full sources and documentation are in the description.